Hello everyone, welcome to the 176th episode of me learning how to trade in Forex. So in the last episode we went through balancing risk and reward. Basically, all trading involves the risk of loss, so every trade, the risk to your capital needs to be worthwhile for you in relation to the potential profit. So there was 5 rules that we were going through of understanding the risk and reward. So we've got rule number 3, calculate your risk versus reward ratio. So you can use the risk versus reward ratio to quantify the worthy of a trade. So your risk versus reward ratio is the amount of risk you're willing to take on in the trade compared to the amount of potential reward. New traders begin with the belief that they have to beat the market or outpredict other traders in order to become profitable. However, it's impossible to predict the future no matter how much knowledge and experience you have. So instead of fixating on winning more, professional traders will usually focus heavily on their risk, ensuring that every pound, dollar, etc. put on the table as risk capital is worthwhile in terms of the potential return. And then we went through the reason why doing this with an example of a coin flip. So basically, if you imagine a game of flipping a coin where you have to guess the results, each toss of the coin is 50% chance of you being correct, because heads or tails. So if you lose £1 when you make a wrong guess and you make £1 when you're right, you're moving towards breaking even. But as a trader, you're not quite there yet, as you need to account for the costs like spreads, slippage or commissions. So even with this arrangement of breaking even, over the long term however, you'll probably lose money due to all these extra fees you have to pay. So to do this, or remedy this, you could remedy this in 2 ways. First, make sure you're winning on a high percentage of coin flips, so you're winning more often, but unfortunately that's impossible. The odds are what they are, so you can only get heads or tails, you can't really manipulate them. Alternative is to win more when you're right than you lose when you're wrong. So many traders try to take the first option and win a high percentage of trades, but although this may seem easier than trying to beat the odds at coin flips, it can still prove very hard to do over the long term. So a much more better approach is the second option. Look for a bigger reward if you're right than you might lose if you're wrong. So this is known as a positive risk-reward ratio. Returning to the coin flip strategy analogy. Now imagine you lose £1 when you're wrong, you still lose £1 when you're wrong, but you make £2 when you're right. So this would be a 1 to 2 risk versus reward ratio because you're risking £1 for £2 of the reward. Now if you're right 50% of the time, the extra profit you make will more than offset what you lose when you're wrong. So in the same way, if you trade with a 1 to 2 risk versus reward ratio, you can be profitable by only being right 50% of the time. You can achieve this by setting your stops and limits at the appropriate levels. So your stop loss and your entry, the distance between them, so your entry to your limit or take profit limit is 2 times the distance from your entry to your stop. So with the coin flip thing again, even if you're right only 40% of the time, you can still be profitable with this 1 to 2 ratio. So if you flip the coin 10 times, you lose £6 from your 6 failures, but you make £8 from your 4 successes. So very good. Did you know, in the 12-month study of traders' behavior and factors affecting the success, found that those who implemented a positive risk versus reward ratio are almost 3 times more likely to be profitable than those who use a negative ratio. So a little bar chart illustration here. Then we went through the quiz. So bear in mind you need to use a guaranteed stop if you want to ensure your position is closed at precisely the level you specify with no slippage. And I went through the lesson summary. So now we're on to controlling risk. Controlling risk. Date is the 24th. Following the first 3 rules will begin to help you manage risk in your trading activities, but these steps alone won't protect you from the risk that a single bad trade could wipe out your trading account if you risk too much on any one idea. So it's important to consider the amount of risk you're accepting on each and every trade. So consider the amount of risk you're accepting on each and every trade. So this is where rule number 4 comes in. Control your risk amount per trade. Rule 4, control your risk amount per trade. Suppose you open a trade on Euro USD, setting a protective stop loss order at 100 pips and a limit 200 pips away. So it's what's it called, a risk versus reward ratio of 1 to 2 here. Can you still blow up your account? Yes, absolutely. If a move of 100 pips equates to 50% of more of your trading account, just that one trade could erase a significant portion of your equity if things go wrong. For example, let's go back to the coin flip game in the last lesson. Suppose you hit a run of bad luck and lose 5 consecutive flips. What happens if each consecutive flip erases 50% of your remaining equity? Say you start with £10,000 in equity. After 5 flips you only have £625 remaining. That's a net drawdown of 93.75%, all because of 5 cases of bad luck. Get back to your original 10,000, you need to generate a return of 15,000%. Since you're now starting from such a small base, unfortunately this isn't likely to happen. Oof. You can avoid this situation by controlling the risk amount of each. You can avoid this situation by controlling the risk amount on each individual trade setup. So, control the risk amount on each individual trade setup. Many professional traders will keep their risk amount per individual trade idea to less than 1% of their account equity. That way, if any given idea doesn't work out, the most they stand to lose from it will still leave them 99% or more of their account equity intact. Keep your risk amount per individual trade idea to less than 1% of your account's equity. That way, if any given trader doesn't work out, the most they stand to lose from it will still leave them 99% or more of their account equity intact. So if your trading account was £10,000, you risk no more than £100 per trade. That way, if you had an unlucky run of 5 consecutive losses, you'd still be left with a healthy £9,500 in your account, which is very good. Suppose you decide to risk 1% of your trading capital on each position. How many profits should you aim to make per trade as a percentage of your trading capital? Suppose you decide to risk 1% of your trading capital on each position. How much profit should you aim to make per trade as a percentage of your trading capital? 2%, right, at least? With 1 to 2 risk to reward ratio. If you risk 1% per trade with the recommended 1 to 2 risk versus reward ratio, you can potentially make 2% of your trading capital if the trade works out. For newer traders, it's a good idea to start with smaller amounts, but at no time should you risk more than 5% on any given idea. You should never risk more than 5% of your account equity on any trade idea. Frankly, markets are unpredictable, and even the most carefully planned trade by the most experienced trader can go wrong. For newer traders, it's a good idea to start with smaller amounts, but at no time should you risk more than 5% on any given idea. Frankly, markets are unpredictable, and even the most carefully planned trades by the most experienced trader can go wrong. Okay, nice little repetition. Okay, homework. If you have any trades in progress at the moment, check to see if your risk versus reward ratio is 1 to 2 or higher. What percentage of your trading capital is at risk on each position, and are you comfortable that you could tolerate this level of loss if the unexpected happens? So let's summary then. A single bad trade could wipe out your capital if you accept excessive risk. Controlling the amount of risk you take on each trade, and risk no more than 1 to 5% of your trading capital on any single idea. Lesson 4. Maintaining discipline. So maintaining discipline. One of the great things about trading in the market is that every day has potential to bring something new. It's what makes trading exciting, but it also means that a good trader needs to maintain discipline and focus. It's all too easy to get engrossed in a situation or a trade whilst losing sight of the bigger picture. Always keep the risks in a forefront of your minds, no matter how confident you feel in your idea. Did you know on January 15th, 2015, an event occurred that caught even the most experienced trader by surprise. Without warning, the Swiss National Bank announced that it would no longer hold the Swiss franc at a fixed exchange rate with the euro. Because of this peg, the currency pair had been popular with Forex traders and was generally considered predictable. Removing the peg caused the euro to plummet dramatically against the franc, and the speed and magnitude of this movement resulted in high levels of loss and slippage on some trades. Nevertheless, those traders who were following our 5 rules had guaranteed stops in place were protected against the worst of this storm. With their losses restricted to manageable levels, it's likely these traders quickly put the incident behind them and moved on to take more profitable positions. So if you want to become a successful trader, look at the markets as a business. By all means hope for the best, but always prepare for the worst. Be pragmatic, manage your own expectations and plan your strategy. Always follow our rules. Always prepare for the worst when trading. Be pragmatic, manage your own expectations and plan your strategy. Always follow our rules. That brings us to Rule 5. Rule 5. Obey all of the rules. Always. Always obey all of the rules. Our final rule might not sound very thrilling itself, but it will let you focus on what really is more exciting. Stay on top of the markets and making healthy, sustainable profits. Yep. To recap, our 5 rules are: plan how you'll exit a trade before you enter it, set a stop when you open a position so you have protection right from the outset, look for a positive risk versus reward ratios because nobody has a crystal ball and you can't win every trade, never risk more than 5% of your equity on any single trade idea, obey all of the rules, always. 5 rules. Plan how you'll exit a trade before you enter it. Set a stop when you open a position so you have protection from the outset. So protection right from the outset. Look for positive risk versus reward ratios. Look for positive risk versus reward ratios because nobody has a crystal ball and you can't win every trade. Never risk more than 5% of your equity on any single trade idea. Never risk more than 5% of your account equity on any trade idea. Obey all of the rules always. Always obey all of the rules. So, lesson summary then. Expect the unexpected in the markets. Keep risk in the forefront of your mind. Plan and prepare. Be disciplined and focused. Follow 5 rules at all times. Expect the unexpected in the markets. Keep risk in the forefront of your mind. Plan and prepare. Be disciplined and focused. Follow the 5 rules at all times. Yep. So we can now move on to the little quiz to finish this off. So, what's the best way to ensure a position will be closed at exactly the level where you want to exit if you make a loss? Set a guaranteed stop. What are the benefits of setting a stop? Select all that apply. Your position will close when you reach your profit target. Nope. You don't need to be logged into your platform to close a position. Yep. Don't need to make a difficult decision under pressure. Yep. You're more likely to make a profit on the trade. Nope. Your position will close if losses reach a level you specify. Yep. When is the best time to set a stop? While opening position, as soon as you go into profit, as soon as you start making a loss, when your loss hits an unacceptable level, while opening position. What is the risk versus reward ratio? Number of losing trades you make versus the winners, a measure of your attitude towards risk, comparison between the potential loss and profit on a trade, mathematical probability of success on a trade, comparison between the potential loss and profit on a trade. Which of these techniques would you expect a professional trader to use to maximize their chances of profitability? Try to outpredict other traders and beat the market? Nope. Focus more on levels of risk than potential returns? Yep. Look for potential profit to exceed possible loss on each trade? Yep. Adopt a negative risk versus reward ratio? Nope. If you traded 1 to 2 risk versus reward ratio, which of the following would enable you to be profitable? Winning 20% of your trades, winning 40% of your trades. I think it's winning 40% with this, isn't it? And losing 60% of your trades. Because winning 40, losing 60, that makes 100%. You set a stop 100 pips away from your entry level on a trade, and a limit 400 pips away. What risk versus reward ratio are you using? Stop, so you're risking 100 pips for 400 pips. Your risk versus reward ratio 1 to 4. Trading for 1 to 2 risk versus reward ratio means you can never wipe out your trading capital. False. What percentage of your trading capital would be sensible to risk on any one position? 1 to 5%, 100%. Mad lads. Which one of our 5 rules is most important to follow on each and every trade? Obey all the rules above always. %. A stop is a resting order that will close your position if the market hits the level you specify. Using a guaranteed stop means you won't experience any slippage beyond that price. So a stop automates the process of closing a trade if the market moves against you, so you can choose your exit point, then leave it to your platform to execute the decision you've made. Ideally, you should set a stop at the outset so your position is never left unprotected. You can move stops later if necessary. A risk versus reward ratio compares the amount of your risk losing on the trade with the amount of profit you could possibly make. So it's impossible for humans to predict the future, so rather than focus on winning more trades, professional traders tend to concentrate on reducing the impact of a loss. Adopting a positive risk versus reward ratio means that the capital a trader risks is worthwhile in terms of potential profit. Oh, the middle one's correct as well. It's possible to be profitable even if you're wrong 60%. Oh, of course it is, because if you're losing 60% of your trades and you're still profitable, then you'd be even more profitable if you're losing less, 50%. Oh, right, yeah. It's possible to be profitable even if you're wrong 60% of the time when you use a 1 to 2 risk versus reward ratio. Remember in our example of a coin game, if you flip 10 times you lose £6 from your 6 failures, but make £8 from your 4 successes. Your risk is 100 pips and your potential profit is 400 pips, giving you a 1 to 4 risk versus reward ratio. Yep. Trading, you always need to consider the amount of trading capital you can lose on any one trade. Even if you're using the recommended 1 to 2 risk versus reward ratio. A single bad trade can be enough to raise your account balance if you take on too much risk. For new traders, it's wise to risk no more than 1% of your trading capital per position. This will leave 99% of your account equity intact if the trade doesn't work out. More experienced traders could consider risking up to 5%, but remember that markets are by nature unpredictable and any trade can go wrong. Following all of these rules all the time will enable you to focus on the important part of trading, watching the markets and finding the right opportunities to make rewarding and sustainable profits. Very nice. So, That is understanding risk and reward done. So now we're on to using stops and limits to manage risk. In this course, we'll look at the practical side of risk management, how you can use stops and limits to add discipline to your trading, and ultimately look to improve your profit to loss ratio. You'll discover tips for where to put stop and limit orders and how to set them in our platform, all demonstrated with examples and screenshots. For a more elementary look at how stops and limits work, try the orders execution and leverage course. For in-depth advice about calculating your maximum risk per trade and risk-reward ratios, take a look at ways to manage risk part 2 in the planning and risk management course and the understanding risk and reward course. Cool, so let's go then. Using orders to control your trading. So, using orders to control your, oh my spellings, using orders to control your trading. It's got a nice little video here.
You can use stops and limits to add discipline to your trading and remove the temptation to make emotional decisions. A stop loss is an instruction to close your position automatically when a certain price point is reached, one that is less favorable than the current market price, helping you to minimize your risk and in some cases lock in a running profit. The three main stop types are basic, guaranteed, and trailing stops. The most widely used is a basic stop-loss order. This closes out a trade when a specified loss is reached. For example, let's say you open a long position for £100 a point on shares of ABC plc, priced at 37 pence, and put a stop-loss at 32 pence. Instead of rising as you'd hoped, the shares fall to 27 pence, triggering your stop-loss and closing your position. That drop of £500, but without your stop loss, you'd be looking at a cost of more than £1,000. That stops don't always close your bet at exactly the level you specified. The market may gap, which means it jumps from one price to another with no market activity in between. There's also the chance of slippage, which can occur during periods of higher volatility, making an order at a specified price, like your stop loss, impossible to execute. One way to ensure your stop is executed exactly where you specified is by placing a guaranteed stop-loss order. This works in the same way as a standard stop, except it'll always be filled at exactly the level you set, no matter whether gapping or slippage occurs. A fee is payable if your guaranteed stop is triggered. IG also offers something called a trailing stop. This is a special type of stop loss that not only caps losses, but also helps protect any profits you make. Suppose you decide to go short dollar-yen at 117.6. You set a trailing stop 30 points away at 117.9, choosing a step size of 10 points. The price drops to 117.1 and your stop loss has followed it. It's now at 117.4. However, now the market trend reverses and the price rises to 117.5. Your stop, however, remains at 117.4, so your position is closed as the price passes through this level. That stop has protected a profit of 20 points for you. However, it's worth noting that if the market's upward movement turns out to be temporary, you may have missed out on an opportunity for greater profit. You can also use limits in your trading. A limit order is an instruction to close a trade at your chosen profit target. Say you have a long position open on XYZ shares. The current market price is $200. You want to close your position if the market price reaches $250, so you set a limit order. The market moves from $200 to $255, triggering your limit order and closing your position. There's no guarantee that the stock will reach your set price, but by placing a limit order, you know that your position will be closed out without you needing to constantly monitor the market level. You can find out more about stops and limits on our...
Cool. So nice little video about the 3 different types of stop losses. So it can be hard not to involve emotions when you're watching position, make or lose money, and emotions make your trading harder to control. You might snatch a profit and miss out on further movement in your favour, or close a losing position too early only to miss a market rally. Or worse, leave a losing position open too long in the hope of rebound but end up incurring even greater losses. Likewise, jumping into trade on a surging market with little or no research and no defined plan isn't a good idea. Tempting as it may be to react in the heat of the moment, enforcing some discipline in your trading is important. You can then develop a consistent trading strategy that will help you achieve a positive risk to reward ratio, winning more when you're right while losing less when you're wrong. Using stops and limit orders is a fairly simple way to lock in profits and guard against loss automatically. They offer a way to predefine where to open or close trades logically while avoiding emotional trading. Ultimately, they can help you achieve a risk-reward ratio that suits your trading strategy and goals. You can set both stop and limit orders in the deal ticket of our trading platform. If you want to set a stop or limit to close a position, you do this from the Deal tab. On the inverse, you set a stop or limit order to open the trade using the Order tab. So using orders, before every trade you need to consider how you're going to control your profit or loss. Consider how you're going to control your profit and loss before every trade. For instance, what risk to reward ratio do you want to achieve? A 1 to 2 ratio means you're willing to lose £1 for each potential £2 gain on your position. What risk to reward ratio do you want to achieve? You should also think about the percentage, you should also think about the percentage of a trading capital you want to risk on each trade. Many stick to 1% of their total equity account. Many stick to 1% of their total account equity per trade. We'll look at why in the next lesson. So think about the percentage of your trading capital you want to risk on each trade. Many stick to 1% of their total account equity per trade. We'll look at why in the next lesson. Once you've determined these, it's easier to plan how you're going to get in and out of the trade to ensure you stay in control of your profit and loss. Might seem obvious, but one of the key ways to do this is to use entry and closing orders, which you can do using both stops and limits. You set an entry order to automatically open a position if the market reaches a specific level, useful if you're speculating on a market trend or support and resistance levels. An entry order automatically opens a position if the market reaches a specified level, which is useful if you're speculating on a market trend or support and resistance. Did you know a market support level is the point at which it keeps bouncing back up following a price decline? Resistance level is where the price repeatedly drops back down following a peak. Trading on this type of market trend is a common strategy used by technical traders. You can set these in the Order tab of the Deal ticket. So price level is your entry order where you're going to be entering. Your position size, £100 per point, so 10, I think this is 10 contracts, okay, Okay, expiry good till cancelled, so it's going to keep going until it gets cancelled, whenever that is. Stops, how many points away. Your limit, how many points away. Take profit limit. Your margin is £30,250. Quite a decent chunk. Place stop order. Closing orders on the other hand let you close trades automatically at your target price level. So closing orders let you close trades automatically at your target price level. This can be done to both lock in profits when a market closes moves in your favor, or cap losses if it moves against you. So to lock in profits when the market moves in your favor, or cap losses when it moves against you. You can add these to an entry order using the stop and limit fields in the order tabs as below. Or you can attach them to a trade you're about to open in the deal tab of the ticket. Size, stop, limit. Yep. Stop and limit orders. Stops let you preset your entry or exit point when a market's price becomes less favorable than its current price. So stops let you preset your entry or exit point if the market's price becomes less favorable than its current price. If you want to close your position or cap your losses, you use a stop loss order to automate your exit. So a stop loss order automates your exit by closing your positions to cap your losses. On a long position, if you place this type of stop lower than the current market price, on a long position you would place this type of stop lower than the current market price, while on a short position you put it higher than the current market price. So on a long position, place the stop loss lower than the current market price. On a short position, place stop loss higher than the current market price. This is because you lose money on a long position if the market experiences a downturn, so you're essentially closing your trade to control how much you lose. Opposite is true for short positions. You place your stop above the current market price since the market is rising. Since the market rising translates to a loss on your position. So we go Bosch over here like that. Inversely, use a limit order to enter or exit market when its price becomes more favorable than the current levels. A limit order, limits to the close are sometimes called take profit orders. So limit order, take profit orders, take profit orders are limit orders to enter or exit the market when its price becomes more favorable than the current level. So on a long position, place the take profit higher than the current market price. On a short position, place the take profit lower than the current market price. So inversely, use a limit order to enter or exit the market when its price becomes more favorable than the current level. Limits to close are sometimes called take profit orders. To do this, you place your limit above the market price on a long position, below the market price on a short position. So yep. So limits to close a long position, limit take profit level here above the current market price, limit below the current market price if you're shorting it, because you're hoping the price is going to go down. Let's say you open a long position on the FTSE 100 trading at 6037.9 at £100 a point. The government is due to make a statement later in the day. Based on your analysis of the market trends following previous statements, you expect the FTSE to fall in the short term before rebounding. You set a stop order at 6017.9, so that's 20 points below the current market price, to protect your capital if the position doesn't go in the direction you expected. So you're hoping for it to go up in the long run, but you know that it's probably going to fall in the short term before going up. Okay, so you set a stop order at 20 points below the current market price to protect your capital if the position doesn't actually go up in the end. You then place a limit order at 6077.9, 40 points above the current market price, to ensure you take a profit if the trade does go in your favour. So we're using a risk to reward ratio of 1 to 2, because you're risking 20 points for 40 points, and if you simplify that, that's 1 to 2. So you can leave your position open to benefit from a rally, but know the maximum you can lose if the market does drop. Note that you don't always have to set both of these orders when you open your position, but they can help you predefine the outcome of your trade, be it positive or negative. Yep. So $603.79, that's 100 point per buy. Yeah, so you buy it hoping it's going to go up. Size 10. What is this? 10 contracts. Does that mean 10 lots? No, not lots. 10. Is that trading £10 or 10 points? 10 contracts. I don't really get what this bit means. 10 contracts. So is that 10 times 100 points? Stop 20 points away. Yep. Limit 40 points away. So the maximum you lose is 2,000. 2,000. The maximum you gain is 4,000. 40 points. So each point is 100. Okay. Ten times 100 is 1,000. yeah, I think you times them together, don't you? 10 times 100 to get your position size. So yeah, working out whether you need to stop or limit can be confusing, especially when you're going long on some positions and short on others. You can always refer to the matrix below to see all the possible options. Here's a quick example of how to interpret the first line, highlighted in the table. So, order, stop, sentiment, long, short, open, close, market level below to limit loss, trade upward trend. Yeah, okay, so this is what we basically went through over here. Okay, yep, so if you're setting a stop or limit to enter a trade in the order tab, the type of order will display automatically in the deal ticket, so you won't be in any doubt. If you're setting a stop or limit to enter a trade in the order tab, the type of order will be displayed automatically in the deal ticket. The type of order will automatically... What, so it's a buy and sell order? Okay. Homework. Have a look at your own positions in the positions panel at the bottom of the platform. Have you thought about how you'd exit these positions? If you haven't already placed stops or limits on your open positions, think about where you could add some to pre-plan your exit. For instance, are there any positions which would put you at risk of losing more than 1% of your overall trading capital if the market suddenly moved against you? You can add stops and limits to them in the positions panel. Wall Street cash, FTSE 100 cash, US 500 cash, Euro USD mini. Size 20 -5 +19 +20 opening latest. So this is your opening entry price. This is the current market price, your stop and your limit and your profit loss here. Okay, so let's summary then. It's important not to let emotions adversely affect your trading. On every trade, potential profit should outweigh the risk of your capital or the risk to your capital. You can use entry and exit, or you can use entry and closing orders to manage how you get into and out of trades. So it's important not to let emotions adversely affect your trading. Don't let emotions adversely affect your trading. Every trade, your potential profit should outweigh the risk to your capital. Your potential profit should outweigh your risk in every trade. You can use entry and closing orders to manage how you get in and out of trades. Use entry and exit orders to manage how you get in and out of each trade. Cool. So I'm going to leave this episode here then. In the next video we're going to go through using stops. So thank you all for watching, and I shall see you guys in the next video. Laters.